Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry educational webinar and analysis webinar in one. Today we're going to be doing a class, an educational session on central banking and understanding what central banks do during times of economic crisis and the impact it has on the economies as well as on various assets within the financial market. Okay, so if you're looking for just a straight analysis, maybe come back in an hour. I'm going to be ranting and also giving information and lessons about central banking, interest rates, what they do, how they work, and so forth. Inflation, how inflation actually increases, and so forth, and how all this information is relevant to what's going on today as we're starting to see central banks shifting their policy positioning to start entering a potential rate hike phase, as obviously you cannot keep this accommodation going forever, and we're going to talk about that. Okay, so first things first, I need everybody to understand exactly why the majority of asset classes in the financial market have been so bullish. Okay, it's not because of COVID supply chain issues, it's not because of demand, it is purely because of these reasons I'm about to tell you. One, low, and in this order: low interest rates, asset purchase program by the Fed, increasing inflation. Okay, now we're gonna be going through this step by step, and starting from the start of the pandemic crash, looking at the investor principles that go on behind the scenes, various investor concepts that are universal, such as buy low, sell high, and so forth. Okay, so the economic crisis of the COVID pandemic gave us a great learning material to really cement concepts of how these economic crises benefit the rich and make the rich even richer at the cost of the middle class and working class. And every economic crisis always further widens the gap between rich and poor. So what we had happen is, when the economic crisis happened, which was COVID, we have to understand that COVID itself didn't lead to an economic crash. What led to an economic crash, for example, oil going into the negatives, the stock market crashing from previous all-time highs all the way down into previous rate hike prices at 18,000 on the US 30. For example, on oil going into negative integers, then coming back up bullish on a rally all the way up back to $88 a barrel now. These crashes that happened were not random, and they were not because of the coronavirus itself. It was because of the coronavirus leading to governments going and issuing lockdowns in majority of countries. So at the very start of the pandemic, to combat the coronavirus and the spread of the virus, majority of governments around the world locked down their various countries. This led to stagnant economies and economic activity across the board dropping. Overall industrial activity, industrial output, manufacturing, retail, whatever it may be, jobs, the job sector, everything plummeted, everything reset. Okay? During this time of initial lockdowns, you can see there is huge uncertainty within the markets, and you see the stock market crash from very aggressive previous high points all the way to 18,000, right? You see something like oil went from $64 barrel highs prior to the pandemic, went all the way to minus $40 a barrel. It just shows us that it went to zero here before having a recovery. If you look at other asset classes, you're going to see at the same time is when they started to go bullish is March 2020. Okay, so look at that across the board now. You had COVID come into the scene, a global pandemic, the world going crazy, but what actually impacted the economies was lockdown. Lockdowns killed the economic supply and demand and overall economic activity. You had economy stagnant. You saw things such as Bitcoin dip a bit lower, oil crash. You saw gold still at the 1400s at this time, March 2020. You saw the stock market crash, even the housing market take a little bit of a correction, right? As you have an economic crisis taking place, you have to understand as the markets are crashing, the central banks can pick any time they wish to jump in and start providing stimulus and support for the economy. Because at the end of the day, the central bank working in hand with the government is the one who dictates the supply of the currency as well as the potential demand in terms of what they are doing with their monetary policy positioning, right? So you had oil go to -40. You had the stock market go to 18,000, right? And as you're seeing this, look at these specific dates. You also had gold go from the highs of 1700s all the way down into 1450s. Look at the dates in the bottom. This is all March 2020 that you're having these various asset classes across the board doing some type of dip from a previous trend and setting up better price points. You can confirm this on Bitcoin. You can confirm this on gold. You can confirm this on oil, on the housing market, on other commodities and other asset classes as well, such as the stock market and so forth. Okay? So when you have Bitcoin come down to these sale prices, when you're looking at the overall trend, you have to see that it was March 2020 it took the dip, right? Gold, before it started rallying aggressively, it did this sharp pullback from 1700 an ounce all the way to 1450 an ounce, March 2020, right? GBPJPY crashed to historical low points. March 2020 is when that low got bought up and it started to rally. Same thing on oil, March 2020. Same thing on the US 30 stock market index, March 2020. Okay? Now, why did we start to have this huge rally from these low points? Well, during this period of March 2020, we had the Federal Reserve and other central banks hit the short circuit breaker on their equity markets. They didn't allow any more short selling. After we conveniently hit the previous rate hike prices, which was 18,000 during the 2016 phase, then we saw them initiate the short circuit breaker and stop any more short selling of the markets. It's not just that. On top of already having low interest rates, March 2020 is the date that the Federal Reserve turned on the money printer and saw an exponential increase in the US money supply. More than 50% of all US dollars within circulation in history were printed post 2020, and specifically March 2020. Okay? So you saw this economic crisis which crashed or at least corrected various asset classes from previous high price points. The housing market, stock market, oil, Bitcoin, and so forth all took a bit of a correction and crash during March 2020 and all created a dip, sell high, buy low, where investors started to buy these dips on these various asset classes because the Federal Reserve, which dictates the US money supply, working in hand with the US government, they exponentially increased the money supply. Now, this has a double-pronged impact on the market. One, why they are increasing the money supply is because they're going to take this money supply and they're going to inject the financial markets through what is called their asset purchase program. So they're taking a majority of this money. Yes, they handed some out to the citizens as stimulus checks, but right now you have some of the most favorable investing conditions ever. Talking about March 2020, you have lower prices on all asset classes. Housing just took a correction. Oil just dipped to historical record lows. The stock market just crashed to low points. You also have low interest rates, which makes it more favorable to invest in these asset classes and hold longer term. Then you have the Federal Reserve increase the money supply, and they themselves say, hey, we're going to take this money supply and make sure the economy doesn't crash. Through their asset purchase program, they're buying up commodities. They're buying up stock market ETFs. They're pumping the stock market. They're pumping commodities. They're pumping the real estate market and so forth. And last but not least is the inflation factor. So for those who do not understand, understanding inflation is extremely simple. Inflation is general increases in prices and fall in the purchasing value of money, okay? So a general increase in prices means the prices of all things within the economy. Everything inflates, everything goes up, and a fall in the purchasing value of money. Just like 1 + 1 = 2, the main reason that the 99% contributing factor of why US economic inflation has been so high is not coronavirus, it's not the pandemic itself, it's not supply chain issues, it's exponentially increasing the US money supply March 2020, right? How can we confirm this? Well, as soon as the Fed started increasing the money supply March 2020, we had a correlated impact on the markets. Now, all of a sudden, your commodities like gold start rallying March 2020. GBPJPY from those lows, risk currency against safe haven, GU same thing, starts rallying. Stock market March 2020 with low interest rates, low prices now, right? Support of the central bank and the greed train starting March 2020, you get that rally. But oil, you get that rally. Bitcoin after March 2020, huge rally because of low interest rates, low prices, central bank support through their asset purchase program, and inflation. But the US dollar, March 2020, exponentially drops in value. The US dollar goes from high points of 103 in value all the way down to 90. The direct impact of inflation was from the Federal Reserve increasing the money supply. So you might ask, Jeev, why do they do this? Well, every single economic crisis throughout history has followed the exact same formula, has followed the exact same blueprint. Anytime you have an economic crisis, it creates a fire sale for the rich. It gives them the best conditions to invest in to give them the best returns possible. It sets up lower prices on asset classes. You also have lower interest rates at that time, which make the investing into those asset classes more favorable. You have the Federal Reserve that literally prints money out of thin air, pumping up these various asset classes. Then you have, because of the Federal Reserve increasing the money supply, inflation doing its natural trick, inflating the price of these asset classes, right? So for the rich, when you're looking at something like US 30, you just had an economic crisis cause huge fire sale in prices in the stock market. You get to buy these various dips. You have the central bank providing financial stimulus and pumping the markets for the next year and a half. US money supply increasing for the next year and a half. Inflation going up for the next year and a half. These are the specific reasons: the low interest rates, the asset purchase program by the feds, the increasing inflation, and the investors, the smart money riding that wave. This is what led to this huge bullish rally on the stock market. This is what led to this huge bullish rally on oil. This is what led to that huge bullish rally on Bitcoin. This is what led to that huge bullish rally on gold, on the housing market, on real estate. Okay? Now, every single transaction has a seller on the other end. Every single reward has a risk, right? There's no one-way street. Every cause has an effect, right? So, who are the ones that pay the price for these huge gains in the stock market? Well, it's us, the working class, as a collective. Because look, The same time, March 2020, that you see an exponential increase in the US money supply, where the Federal Reserve and government works hand in hand and clicks a magic button, as it's all a fugazi, it's all a fugazi, it just printed out of thin air, it's not backed by shit, right? It's literally a magic show. The whole financial system's a magic show, and just dependent on trust. But that's a conversation for another time. So they hit their magic money printer. They exponentially increased the US money supply. Now look, this is the United States CPI chart. What exponentially starts going up after March 2020? All of a sudden, US consumer prices starts to go through the roof. Just magically, the same time the money supply goes up, the same date, just magically inflation starts to go up. No, it's not magic. It's the equations of economics. It's like the simple equation of, if you have a high supply of something and a low demand, the value goes down. If you have a high demand for something and a low supply, the value goes up. Right? So you have an increase in the US money supply, a decrease in the US dollar overall. So you can see the dollar itself plummets in value. The dollar index chart, March 2020, it plummets in value. The same time they start that money printing, it plummets. Right? So we have to understand that after this crash point at March 2020, the central bank working with the government chose these specific price points to start jumping in and providing fiscal support. Okay? So you have to ask yourself these questions. What made this bullish rally so favorable over the last period of 2 years? Well, low prices, low interest rates, asset purchase program by the central banks, and increasing inflation. Right? So now the reason why this is relevant is, what have you seen over the last week happen on global equity markets and asset classes? Right? Even though they're starting to recover a bit now or bounce, you can see that you had this very aggressive correction in price. You can see it on the equity markets across the board here, right? Now, the reason why we had this short-term fear develop into the scene is because you have to look at the market through the eyes of the smart money investor. All of the conditions that made buying the stock market so favorable and buying these various dips over the last 2 years, those conditions are starting to change. We're starting to have the central bank flip the script now, because they have to start combating the increasing inflation. Now, inflation is a very, very tricky game to play with. Like I said, when you have an increase in inflation from an increase in money supply, this inflates the prices of everything within that economy. Consumer goods all the way to investments. For the rich, this is great. Their investments just go up in value even more. For the working class and poor, this sucks. Their day-to-day consumables just go up in value, and then obviously their cost of living goes up at the same time the buying power of their dollar goes down, right? So now we're not having the same favorable conditions. We're at record high price points. We're having the Federal Reserve and other central banks saying they're starting to look at interest rate hikes and interest rate increases. We're having the central bank saying they need to start combating the increasing inflation. What this means is the stock market and these various asset classes, as we're at these all-time high price points, no longer buy low. As we're having interest rates going up, as we're having inflation start to be combated when interest rates go up, the inevitable thing to happen is start to see a correction on the stock markets. In my opinion, this correction can come down to pre-pandemic price points at 30K before seeing another rally to go back up to the bullish side. Okay? Okay? The conditions that made investing in oil, investing in gold, investing in crypto, investing in the housing market and stock market, the conditions that made it so appealing for smart money over the last 2 years, those conditions are starting to change. We're starting to see that interest rates are going to start to go up. When interest rates go up and the central banks stop their asset purchase program, this means that inflation is going to start to get combated. As inflation starts to decrease, as interest rates start to go up, you're going to start to see the equity markets enter a corrective bear market phase for an extended period of weeks or months. I think this correction can easily see the stock market go back to 30K flat and still be maintaining the overall bulls. Let me give you an example, okay? 2008 financial crash. You can see the financial crash happens. The central bank chooses when to hit the short circuit breaker and stop any more short selling in the market. They also increase the money supply here. Same ideology. You have extremely low prices. You have the Federal Reserve doing an asset purchase program, low interest rates, and increasing inflation. You have an extended rally on the stock market with minimal pullbacks for the next year and a half after that. Then as the Federal Reserve starts to taper stimulus, you get a little bit of a correction. Then as they increase interest rates, you see this corrective bearish market where from all-time highs, you don't have another crash, but you have a larger correction that was not seen during the rally. From that correction, you have a dip created and then a continued rally for the next years later until the next rate hikes and until the next economic crisis, right? So with the inevitable rate hikes, I think this gives smart money a lot of reasons where even if we dig a little bit higher here, we're most likely going to get a pullback and still see some corrective bearish market structure to 30K, previous highs prior to the pandemic, before continuing bullish again overall. Does that economic lesson make sense? The economic crisis, how it was very surgical, how it was very timed, how the governments and the central banks choose when to stop the short selling, they choose when to jump in and start providing support. What literally led to an increase in inflation, the impact of the increase in money supply and what the Feds did, the impact on the various asset classes, the impact on inflation, the impact on all these assets like Bitcoin, oil, stock market, housing market, and so forth. That was just a quick little economic crash course. All right. The reason why I am talking about this is because this week we have FOMC. So no, you always have a steady overall increase in money supply, right? Like here, you have healthy increases in money supply. You can't even tell, but you get these blips during economic crisis. This was in the 1980s. This was 2008 increase. This was the 2020 increase in money supply. This is a chart from 1960s to now. You had a steady increase until 2020, huge shoot up. This is what led to the increase in inflation. This is it. It's not supply chain issues. It's not some truckers being stuck at the border. It's not the government saying, oh, it's XYZ. It's not COVID itself. It's not the lockdowns either that caused inflation. It's the increase in money supply that caused inflation. But the governments and the central banks can't tell you this because this increase in money supply over the last 2 years made them even richer. The inflation made them richer. The asset purchase program by the feds made them richer. The low interest rates made them richer. If you tell that to the regular retard in the society, they'll be like, oh, what the fuck, huh? Wait, something's not right here. But they're fucking retarded. The people are retarded. These economic cycles keep repeating throughout history, but the masses are so dumbed down to even notice what's happening right behind their back. It's money moves. It's all about power, control. Inflation only negatively impacts the working class people. The buying power of the currency goes down so they can buy less goods, and the cost of goods goes up. So they're the ones paying the price as a collective, the millions and millions of people. Inflation increases for the rich is gravy. It makes their house prices go up. It makes their commodities investments go up. Stock goes up. Right? But you cannot sustain just continually printing money and keeping interest rates low, because even inflation can enter dangerous territory for everybody, which is hyperinflation. Hyperinflation will cause an economic depression in itself. Do you understand what I'm saying? So now we're coming to the stage where the feds need to start combating the inflation, because if you keep this going, you're going to hit hyperinflation stages. Okay? So, why is this important? Because the market, as you can see yourself, has been purely following central bank policy positioning. The entire market. You can see what's happening across the board, right? You can see the fear, uncertainty, and doubt developing and so forth. But anyways, that was just a quick economic crash course. Now let's talk about the actual analysis and stuff for the Monday market update webinar. You might need to rewatch this again, which is perfectly fine. You can go Google anything I said yourself as well. Okay, now let's jump into it. So, as we have had majority of central banks going into the tone of looking to start raising interest rates, we saw a massive sell-off on global equities. This is because of the fear, uncertainty, and doubt developing over rate hikes to come. Smart money, the investors who have been riding this greed train, they're worried about the economic stability post rate hikes, okay? Because you have to understand that the majority of the financial markets have been propped up artificially by the central banks and government spending and increases in money supply, right? The low interest rates, the increases in money supply. The stock market, for example, oil hasn't been extremely bullish because oil consumption's been through the roof. Oil consumption is back to regular pre-pandemic levels. It's not higher than it was before. Oil companies' revenue is still the same. It's because of inflation. It's because of low rates. It's because of the asset purchase program. The stock market isn't so bullish because every single company's earnings is through the roof and every single company is so prosperous. No, it's because of the low interest rates, the asset purchase program by the feds, the inflation. The majority of these asset classes, even crypto, have been bullish because of artificial reasons induced by the central bank money printing and monetary policy. So when the central banks are going to start to look to do the opposite, what do you think is going to happen on these markets? An inevitable correction. I'm not saying you're going to have a market crash, but you're going to enter a bear market on these asset classes. Gold, oil, stock markets, housing market. For a couple of months, couple of weeks, you'll enter a corrective bear market as you price in the potential rate hikes to come. Okay? We can also see that global tensions are coming back to the table. We're seeing headlines regarding Russia and Ukraine starting to escalate. We're seeing Brexit issues and tensions coming back into the table as well. Economic data to start 2022 so far, such as labor market and PMI figures, have also been softer. So this fear, uncertainty, and doubt, we can see, had an impact on investor behavior and sentiment. You see a drop on the equity markets across the board, right? You see dollar and Japanese yen holding strength on the intraday time frames with the inevitable rate hike rumors to come. Dollar holding strength here on the intraday time frames. Japanese yen holding some strength as well. Volatility index more bullish. Okay? So we are looking to play this fear, uncertainty, and doubt sentiment accordingly. But what I want you to understand is now when we break down the individual technicals, I'm going to show you some really interesting stuff across the board on how these pairs move. All right. So now we understand that economic breakdown of central bank policy positioning, what low interest rates do, what higher interest rates will do. We understand the current fundamental sentiment as well. Before we jump into our analysis, both technically and fundamentally, let's just make sure we know what economic events we have in the docket. So overnight tonight, we still have some CPI figures for Australia, quarterly and yearly. I don't personally trade any Australian dollar pairs, but if you do, keep an eye out. 7:30 Asian session hours, CPI figures for Australia. I'm personally expecting these inflation figures to still be high. Okay? Overnight, this is primarily our focus for the London and New York trading session in the morning. We have some business climate conditions report for Germany at 4 a.m. Eastern, which is going to be impacting euro pairs. At 6 a.m. Eastern, we have some CBI trends orders for the UK, which is going to impact GBP. At 9 a.m. Eastern, we have some Case-Shiller data, yearly and monthly, which is going to be impacting from the industrial side on USD, US equities, and so forth. The more important one for US economic impact is the consumer confidence report. I'm expecting higher inflation and weaker economic data across the board. I expect the consumer confidence to be dropped and continue to that as well. Yes, Matthew, correct. But I think the corrective structure on the stock market can easily take us like on US 30 down to like 30K, and it'll be a repeat of what we saw 2008, right? So you'll have this huge bullish rally, economic crash, and then this was the correction here. This was the rate hike correction. And then after that correction, price stabilizes, the buyers jump in, and you continue bullish. But you can see for that period of months, the stock market is in bearish market structure. Bears in control. It's in that corrective fashion. So of course, I don't see the stock market crashing. I don't see any of these asset classes crashing, but I see them entering inevitable corrections where here on the US 30, even if we came down to pre-pandemic prices at 30K, man, this would be a great dip for me to buy in as well. Then you hold that for the next 2-3 years until another crisis comes. You know what I mean? So I would personally love it if we come, even if we come to 30K, the market's still so bullish. You have to understand, we went from 18,000 all the way to almost 38,000. We're like 5,000 points above pre-pandemic all-time highs. Even if we came to 30K flat and had some bearish corrective structure, this would be a great dip for buyers, in my opinion, a great demanded price point, and then we just continue our bullish rally, stonks forever bullish for the next 2 years after that. Does that make sense to everybody? I'm not seeing a market crash. Like on oil, maybe we come back down to $60 a barrel before continuing the bullish rally. On Bitcoin, maybe we come back down to $15,000 a coin before continuing the bullish rally. All I'm seeing is an inevitable correction on these asset classes as investors take profit from all-time highs, interest rate hikes come, and you have that dip created to more favorable prices and demanded prices, right? It's just the economic cycles. It's just the repetition of economic cycles. You know what I mean? But anyways, now let's talk about our intraday analysis. So on gold as a precious metal safe haven during this fear, uncertainty, and doubt has been a lot more bullish. You can see from this intraday demand zone, we keep collecting more and more buy orders, right? And having stronger bullish market structure. Buyers continuously printing intraday highs, having pullback phases or consolidation zones, and potential continuation breaks to the upside. Very nice bullish market structure. Also, if you guys have been following the capital hungry resources for free, like the YouTube and such, if it loads, I was talking about the US 30 sells. I've been talking about US 30 sells since here 2 weeks ago. I've been talking about the market fear developing since these terrible data webinars, the gold buys over the last 2 weeks and stuff as well, the higher inflation, right? So you have tons of educational webinars here. Some are like long like this, some are quick 60-second webinars that'll give you tons of information on inflation, data, trade ideas. These gold buys played out absolutely great. Look at this. Let me see. Where's the trade ideas? Whatever. From the 1836 area again. They played out great. But you guys can go watch that stuff yourself. So anyways, with gold, as long as inflation is still staying high and we're maintaining this overall bullish market structure, right now we're just in a consolidation phase. My expectations is to break out of this consolidation phase and continue our way up into revisiting this supply zone at the 1860s and 1870s. Right now, the intraday market structure is far too bullish. So these are the trade ideas I would see on gold. Fundamentally, with the current fear, uncertainty, and doubt of the massive profit taking on equity markets, this helps keep gold more bullish. Global inflation is still very high. This also helps keep gold more bullish. Even though we have inevitable rate hikes to come, you have to understand gold as an asset class is treated as a safe haven. It's used to hedge against periods of high risk, right? So with gold, as long as we remain above previous highs at 1828, I am still in a bullish bias. I would be looking for pullbacks to 1832, pullbacks to 1836, buys above 1845. Right? Fundamentally, the reasons we stated we are bullish: risk hedge during times of fear, uncertainty, and doubt, higher global inflation, technically, very nice bullish market structure, buyers keep printing intraday highs. You can't say that this is a resistance. To me, this is just a consolidation zone where we're having orders generating in the market before having enough volume to continue with the current trend. Let me give you guys a great example of this, right? For example, look at something like this, where you're having overall bullish market structure, but sometimes you enter these consolidation zone phases instead of just having impulsive moves and pullbacks. And unless you break to the lows of the consolidation zone, overall, you're maintaining the integrity of bullish price action and market structure. And this break above the consolidation zone, these few candles, that's like 300 pips on gold, right? So when you're looking at the current structure in this current bullish rally here, you don't really have any confirms whatsoever of exhaustion by buyers yet. We've just been consolidating at a high. My assumption is that we're collecting buy orders because of the current bullish fundamentals and bullish technicals. So those are the trade ideas I'd be looking for. Okay? Green boxes being the buy zones. This is my main bias. I would only jump into sells if we broke below 1828. That's the only way I'm switching out of my bias. I've been playing the gold buys for the last couple of weeks. Been playing the GJ sells for the last couple of weeks. I'm sticking to that same bias. Besides having some intraday pullbacks, which I'm going to talk about now on GJ. Okay? Now on GJ, I want you guys to notice something very similar. First of all, this 149 area, right? This 149 area here, very key daily demand zone that we haven't broken since prior March. Gold is coming here, Bitcoin, sexy banter. You're saying gold's going here, Bitcoin's going there. Shut the fuck up, bro. I'm the one giving the analysis right now, actually giving information, streaming to hundreds of people. If you want to give analysis, go start a stream. Don't distract people who are trying to learn from somebody actually breaking down why something may happen and the analysis behind it, besides somebody else just sending messages in a chat. You know what I mean? Fucking retard, bro. Alright, so first thing, notice this demand zone. Now, 149 demand zone. Alright? Now look at this exact same repetition here. I want you to look at this. It's beautiful. It's absolutely beautiful. Okay, look at this. Ready? Demand zone here. You get a double bottom at the demand zone. The double bottom leg is at the exact same price point. Right? Once you confirm, all the technical double bottom here does is confirm sellers are exhausting out and buy orders are being collected from the demand zone. Breaking above the double bottom first leg shows a lot more buyer order flow and momentum. Once you break above that double bottom leg, you get a strong bullish rally all the way to 158. Then you come to this supply zone, fail to break that exact same price point. From this price point, you start to enter stronger bearish market structure where for the first bit, it's very corrective. And then with a fundamental catalyst, you have a more aggressive bearish melt that comes down to that same double bottom leg price point. Right? Do you see the exact same technical and fundamental repetition that's happening behind the scenes. Number one, coming to this demand zone at that time, sellers fading out, collecting buy orders. Buyers extending that rally all the way to that 158 higher time frame supply zone. Buyers starting to take profit out of the market. This creates this corrective pullback structure. You have a fundamental catalyst lead to an impulsive break to the downside. Here, it was Bank of England, November Bank of England rate decision, where they didn't hike rates. Here, it was the market fear and massive sell-off in global equities, right? As you start to peak this area, you have a pullback phase and then continue your way back down. Pullback phase, continue your way back down is what I'm expecting to come. It might not be exactly the same, but in the markets, that's pretty surgical. That's pretty similar. The fundamentals behind the scenes of the bullish rally, the fundamentals of what's causing the downside move, the technical repetition, it's almost exactly the same. Does that make sense to everybody? So on GJ, I'm still in a bearish bias, but I do see us potentially having a pullback phase to revisit better sell areas before continuing down. Like here. Here you had a massive meltdown. You start to reject. You get a deeper pullback before continuing your way down, right? So now what we're going to be looking at is we had a very strong bearish rally. If we can have the potential to enter a pullback phase before continuing our way down. But we're going to be taking this step by step and level by level. Right now, we are still maintaining the bearish market structure below this price sensitivity area at 154.5. 154.5 is the last price sensitivity area that led into these lower lows, a pullback to 154.5 that led into these new lows being printed. Right now, we're still maintaining the overall bearish market structure. I can't see any deeper pullbacks unless we were to break above 154.5. What I can see happening is this. Pullbacks to this order block. If we don't break above, continued sells to the downside, at least targeting these previous lows. Okay? Only take GJ buys if we break above 154.5. And then those buys will be short-lived to retest 155.5. Again, just expecting continuation with the sells. Okay? So that is the main analysis for GJ. My main bias is sells. We can see that overall though, the UK equity markets, they had a pretty aggressive bounce, but still very bearish on the intraday timeframes. The Japanese yen is still holding some strength for the time being, holding above these previous lows. We might get a deeper pullback, but as long as we remain below 154.2, this previous price sensitivity area is here, we're still respecting the bearish market structure to revisit these lows, right? We're just anticipating, like we saw here previously, that you can have these pullback phases created in the market before collecting more sell orders and continuing your way down. All right? Now, GBP USD, we have and how many times did I tell you guys about this broad bearish market structure? Who remembers the last update webinars where I said this on GU was just simply a pullback? A pullback from the start of the new fiscal year to go retest a better supply zone, collect more sell orders, and as dollar strength comes back into the table, we are going to make our way down to revisit these lows. Okay? So right now, what we can confirm is the exhaustion on the UK equity markets as well as US dollar holding individual strength. But you have to understand, as GU plays with the trend and goes back into the bears, you can see it has these minor pullback phases as it's making its way down, right? So when we're looking at GU here with the current structure, this is what I see for setups. Short term, like just like this little pullback structure here, right? Short term pullback buys above 1.35 to retest 1.36 before continuing down bearish again. If we break above 1.35, short term pullback buys to set up better sells at the retest of these previous lows and retest of bearish structure even at 1.36 again, then scaling back down accordingly. Okay? Or if we don't break above 1.35, just continued sells below 1.345. The buy play would only be a short-term pullback, which can still run 50, 100 pips to set up the better sells to come. Let me give you an example. Look at here when you can see, the sellers are in play and you start to have the dollar strength. You make your way down overall, but you have these short-term pullback buyer plays that go to retest bearish market structure or previous lows, collect more sell orders before continuing down, right? It's the way the market moves, the constant transactions between buyers and sellers, right? So it wouldn't be out of the normal to see that happen here. A short-term pullback above 3.5, we go back to 3.6, sellers jump right back in, we continue down. Does that make sense for everybody? Same idea as like GJ, seeing a potential short-term pullback, going to a supply zone to collect more sell orders before overall continuing your way down with the trend. Same thing I'm seeing here on GBP USD is a potential short-term pullback to 3.6 before continuing our way down. So short-term buys above 3.5 to set up the better risk versus reward sells, or just the breaks below current lows medium-term zone. Red boxes are buy areas, red boxes are sell areas. Obviously, green boxes are the buy areas. And remember, if we do get the break above 3.5, that pullback, and you take the buys, don't start to marry the bias. You have to understand you're playing that potential pullback just to retest better sell areas. You're just playing that pullback. Same thing on GJ. If we break above 154.5 on GJ, you're just playing the pullback. Yes, on the equity markets, I'm going to talk about that too. I'm just expecting a pullback and continuations to the downside. And I'll talk about something fundamental on the equity markets as well. So those are the trade ideas so far for gold, GJ, GU. EURUSD, we're bearish. The only thing with EURUSD is the overall structure is bearish. Same idea when you're looking at the trending market. Overall, you're having downside moves, pullbacks, continuations to the downside, minor pullbacks, consolidation zones, breaks to the downside, pullback. I'm expecting us to at least continue down to these previous lows, playing the US dollar strength. The only thing is we're in this messy consolidation zone at these lows. But within this consolidation zone, I'm in a bearish bias expecting us to drive down to the lows, playing the overall bearish market structure, dollar strength as the world reserve currency. So when we're looking at trade ideas on EURUSD, you can see price action gets messy in here. So it'd be perfectly normal to get a retest. I'll still be looking for sells from these areas stated. 1.36 retest. 1.385, 1.31 sells. Okay. USD Cad. As we're seeing the dollar strength come back into the table, stronger bullish price action after having this consolidation zone and exhaustion by sellers break to the highs and short-term dollar strength, I'm still in a bullish bias on USD Cad above 1.26. $2.6 buys, 2.66 buys, breaks above 2.7 buys. We can get a potential deeper pullback, but breaking back above this area, as long as US dollar continues bullish, we get more rate hike talks by central banks. We see profit taken on the equity markets. I see that. Continued upside. Now, equity markets. You can see that we had a huge drop on the equity markets and a very aggressive correction and bounce from these demand zone areas here across the board. Around 33,500. Give or take a few hundred points, but on the higher time frames, right? This is perfectly fine. There was something that I learned as I was watching the, as I've been watching the equity markets and watch an economic crisis. For example, look at the economic crash here. Can you see that during the economic crash, every single time there was a dip, you would get very aggressive buy bounces? These are the dip buyers on the equity markets buying up the lows, but if the overall fundamental sentiment doesn't change, the dips get faded out just as fast and you continue your way to the downside, okay? So right now, we can see that we had a very aggressive bounce from these lows. But at the end of the day, the price action here is still far too bearish. In my opinion, we can see this dip extend up a bit higher, all the way up to 34,800, 35K again, and still end up making our way back down to these lows and even lower. All I see this as is desperate equity market buyers grabbing the dip. But if the overall fundamental sentiment doesn't shift, I can see us making our way back up to 35K, but still getting faded out, making our way back down to these lows. So these are the trade ideas I see on US 30, okay? If we hold above 34,600, short-term buys to 35,500, 35,200, setting up better risk versus reward sells in this area, still playing the inevitable correction to come with rate hikes and the shifting in order flow sentiment. Okay? Or if we just have a minor pullback but come back below 34K, continued sells. Okay? So I can see this dip that buyers have bought up extend a bit higher, but if we don't break back above 35,200, the corrective structure and the bears are still in play. Does that make sense for everybody? For example, we've had very aggressive dips and corrections like this before. Let me give you guys a great example. Look at something like this, right? From the highs, you have this profit taking and dip created. From the dip, you get a huge bounce, but it doesn't fade that previous price sensitivity area. You go back down to these lows again before really starting to create a support and rallying again, right? This situation is also a lot different, where we weren't as close to interest rate hikes as we are now, right? So we're seeing the exhaustion at this 36,600 price point. we're seeing the bearish market structure being formed. As long as we really stay below these previous low areas here, we might get a bounce in this area, but if we don't fade that out, we can easily make our way back down to these lows again. You just have to understand the stock market buyers always aggressively buy up these dips. Okay? But overall, I am starting to see the fundamentals start to shift, starting to enter potential corrective markets on these various asset classes as we have central banks reaching the inevitable point to start increasing interest rates. As they increase interest rates, this is going to give more reason for these asset buyers to start profit taking, liquidating positions, selling. Okay? But anyways, everybody, thank you for attending this crash course. It's been very long now. If you guys enjoy this educational content, if it helps you learn a lot, please make sure to send a like, send a comment on the save stream after as well. That is the macro analysis and educational breakdown on central banking, inflation, monetary policy, as well as a Monday market update about what's going on in the markets and some potential trade ideas across the board. Okay, I'm going to get out of here now. This will be saved and uploaded so you can always rewatch it whenever you wish. And I'll see you all next time.